Hey everybody, my name is Kyla. Welcome to my channel where I talk about the stock market and the economy amongst other things. Today we're going to be talking about the Scoville Test for the economy. So I'm going to be talking about how to figure all this stuff out because man oh man, is it confusing. So this is also a newsletter, kyla.substack.com, as well as a podcast called Let's Appreciate. So go check those out if you're interested. Let's get into it. Everybody is anticipating a recession. It's kind of like this general sense of foreboding where everyone is watching a tree get chopped down and the tree will fall eventually, right? It'll land somehow, but there are a lot of questions to answer in the meantime. We're entering earnings season, and the general idea floated by a lot of companies is that some sort of mild recession is coming, but no one really knows what that means. All the Davos people are on their little stage chatting about how the world is going to end. 2/3 of economists expect a worldwide recession in 2023, but nobody knows when or where or why or how. So the consensus is a mild recession. The general idea of a mild recession is that growth isn't great, but things are okay, like a splinter in your finger, kind of. Something that's annoying but largely manageable. Somewhat of a slowdown in the labor force with unemployment rising somehow despite a gap in said labor force, housing market blowing out even as home builder sentiment improves, yield signs and manufacturing, which is already happening, rents slowing, which is also already happening, and consumer spending slowing, which maybe it won't slow to be that bad, you know? The data is starting to show that something is coming, and it could start now, it could start in 2024. It's the slowest tree fall of all time, and if you search the word mild in Bloomberg's 2023 Wall Street predictions, you get a bunch of things like this, where people are just talking about mild and nobody really knows what it means, but we all kind of are like, okay, it could be mild. Nobody really knows what anything means, right? The economy is basically a guessing game of sorts, and it's kind of like the Scoville test for peppers. So the Scoville test for the economy, the Scoville test is really imprecise. It's how we rank pepper hotness. And because it's based on human subjectivity, because everybody has a different mouth going on with a different palate and different taste receptors, we all know that the pepper is hot, but like how hot is hot really, and everybody has a different experience of hotness of peppers. So if we decide to apply the imprecise measurement of the Scoville scale to the economy, which might just be like as accurate of a framework as anything else, a really spicy pepper would equate to a hot recession, a semi-spicy pepper would be a moderate recession, and a non-spicy pepper would ideally be a mild recession. So let's say that we have a mild recession, a subjective poblano on the Scoville scale. And so now the question is, what comes next? If the recession is a mild poblano pepper, how long will it be mild for? As Pete Bookvar has highlighted, it's more than just how the recession comes, it's the recovery that follows. So a soft landing, but how soft? Or hard downturn, but how hard? And what does all of that even mean, right? How long does the pepper burn your mouth for? Do we need to pour a glass of milk on the economy, or can we go about our day with a slight sweat sheen on our brow? Or do we accidentally drink carbonated water, which apparently makes the burning sensation that much worse? Ideally, we want to be where the whole milk is, right? We want a soft landing, a mild recession, or ideally no recession at all. But of course, that's where it gets complicated. With all of this, there's data, and then there's action. So with movies, you can look at the box office for Avatar and say, well, it looks like people are doing super duper well, like Neil Dutta said in a recent Odd Lots interview. And you could also point to the improvement in home builder sentiment and the movement in bonds, where people are snapping up investment grade bonds, and nod wisely and say, yes, the economy is absolutely moving and grooving along, but it gets worse. You could point to tech layoffs, and Microsoft just laid off 10,000 people, and the collapse in manufacturing, and say, well, things are not doing that well at all. What the Fed is doing, talking and raising rates, is just starting to impact the economy. We're just now starting to see things really begin to slow down, and the question is, of course, how long will things slow down for? So we have a weird combination of stuff right now. With the data that has come out recently, it's very clear that the economy is slowing down, but the Fed seems unlikely to budge despite these clear caution signs flashing, with Bullard, who is a non-voting member, booming about 50 basis points rate hikes. With that, the combination of the Fed not budging and the data continuing to weaken, a soft landing seems more likely to be a hard downturn. Things are slowing down, but not slowing down enough for the Fed to say, oh yeah, that's good, we'll chill out now. The worry is that the Federal Reserve goes too hard. So some of the data points here, the disinflationary data points would be industrial production falling, hiring and wage growth slowed here, the Empire Manufacturing Index fell to lowest level since May of 2020, driven by a continuous fall in new orders and shipments. The Beige Book has also highlighted a big slowdown in the economy where things are becoming stagnant. Retail sales are falling. They fell 1.1% in December. This is a broad-based slowdown that shows that the consumer is really not doing well to a certain extent, and they aren't willing to take on another 17% price hike in Slim Jims. And this might be an unpopular opinion, but consumers shouldn't have to take on more price hikes. I know that it's getting more expensive for companies to make things. I know that they're just raising prices because they can. I get how capitalism works, but raising prices in the anticipation of higher prices, which which is what a lot of firms did, is not good. This was a major driver of inflation in 2021, and it caused excess pain with potentially excess action from the Federal Reserve. It's not just supply and demand, but it's the influence of companies on supply and demand. If companies are charging almost 20% more for meat sticks, consumers are going to push back eventually. People are also running out of money. The savings rate continues to fall, and people are taking on more and more credit card debt to finance their payments. Rents are falling, another disinflationary data point, 3% in the last 3 months on a seasonally adjusted annualized basis, according to Connor Sin. People aren't demanding new apartments, so rental growth has to slow as vacancy rates rise. Headline PPI fell by 0.5%, more than the estimate of 0.1%. All signs of inflation easing for producers, which ideally means that things will ease for consumers too. And of course, on a mechanical level, the treasury curve between 3 months and 10 years has been inverted for the past couple months, and it's the most inverted since 1981, meaning that markets are like, yeah, a recession is coming. But they've been saying this for months. There's a lot of softness in the manufacturing sector. The consumer is starting to fight back too with resistance to price hikes. But of course, there's the other side to all this data. China is reopening. This could create some inflationary pockets across the board as 3 years of pent-up demand is unleashed on the world. There's labor market gaps too. So initial jobless claims are easing, but nowhere near where the Fed wants them to be. A lot of people retired during the pandemic, and they probably are not going to be coming back to work unless we have a huge problem on our hands, which means that the labor market will essentially have to be reinvented, which I think is good. Through better immigration policy, working parent support, and support for workers with disabilities. But Microsoft laid off 10,000 people, and Amazon's layoff just hit. Tech and finance are likely in a deep recession here. Bond investors are going hog wild for bonds with $600 billion in sales this year. Everyone wants a piece of the bond market, a sign that they aren't that worried about a recession. High yield is off to a slower start, but is showing signs of picking up steam too. Markets are getting comfy, but the Fed is likely going to continue on their hiking journey. Demand has spiked from a pretty low level, so it's pretty relative. And mortgage rates are running at their lowest level since September 2022. But mortgage payments are now running 45% of annual household income, a massive spike over the past couple of years. There could be more upward pressure on inflation moving forward. An echo effect as we start to see labor contracts reprice and residual prices move higher, which could create some inflationary worries. The BOJ is likely going to make some moves too, which could create even more waves of worry. Also, as Mary Daly said, markets are priced for perfection. Applying a matrix to our Scoville test, we can see what would drive the soft landing versus the hard downturn and the hot recession versus a mild recession. A lot of it boils down to the Federal Reserve, but it's also important to pay attention to the labor market, consumer health, housing, etc. And of course, the big question now here in the United States is the labor force. We have pandemic era retirements, and those people likely aren't going to come back unless things get really bad. The firms will likely need to continue to raise wages, and the Fed won't love seeing that because of their worries of wage price spiral land. However, we did just get the price spiral, so maybe we could get the wages just a little bit. And it will be a delicate balance. We have more headwinds as we deal with debt ceiling, digesting the economic data, processing the momentum of a slowing economy. This is a new world for a lot of people, myself included. I was very little during the last recession, so it's new, it's different, and it's weird. So some final thoughts. There's this whole thing in the United States of rugged individualism, where we're taught from the time that we're born that the world is ours to conquer, which is good. But if someone falls as we're climbing, sucks to suck, brother. You should have climbed harder. And I think, it's fine. It's okay. Just how it is. But there's a general level of acceptance that has to come with that, because there are some positives too. But I also think it distorts how we think about the economy. When we think about the labor force, Target recently raised their minimum wage to as much as $24 an hour, and they're going to provide insurance to workers who work more than 24 hours a week. And a lot of people are going to bemoan that and be like, oh, those people aren't working hard enough. They don't deserve a living wage, which is absurd. If we can create a world where our people are taken care of, where everyone has a place to live, where we're not constantly worried about where the next meal is coming from, that's not positive for everyone. And I know in our brains, we're like, no, it can't be that way because somebody has to be suffering. I'm just saying, I think the world could be a little bit better off if people were better off on average. And I thought this quote from Larry Fink was kind of funny because markets are based entirely on hope and expectations. And I think people do expect things to get better over the next 30 years, but stocks go up isn't always a happy world. He said, BlackRock is a firm that tries to sell hope because why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? We're likely facing some sort of soft downturn scenario just based on the storm of data coming forth. A mild recession is still a recession. Even if 1 million people lose their jobs, that's still 1 million people losing their jobs. And these are people with families and plans and dreams, and it shouldn't be this way, but it is, right? So no one knows what a mild recession is. No one really knows how long it'll last or what will happen, but it's the base case for a lot of people. We're starting to see the slowdown begin in the numbers. The question now is how resilient the people, not consumers, people are in the face of adversity and how corporations handle a changing economic environment. A mild recession is subjective, just like pepper hotness. Our world is rapidly changing. Models made from the 1970s to 2019 probably won't fly anymore. There really isn't anything to say in the face of a downturn, especially one that isn't technically a downturn yet. If anything, it might be a bifurcation. Tech and finance will flop around when other parts of the economies will be bolstered by reallocation of capital, which honestly should have happened by now. Tech has taken a lot of money. There's no platitude for any of this, though. It's just economic cycles, and that's all. There's no way for me or anybody to really paint rainbows and butterflies on things like this other than, oh, it'll get better one day. Because suffering is just sometimes suffering. But there's hope on the horizon, and there are opportunities down the road. And if a tree falls in the forest, it does make a sound. Thanks so much for hanging out. Thanks so much for spending time with me. This is a podcast newsletter. I'm on Twitter, TikTok, I'm everywhere, Instagram. I hope y'all are doing okay out there. I have some links in the newsletter if you want to go check those out. But yeah, go ahead and hit the subscribe button. It really helps. Share with a friend. That also really helps. And I hope that y'all are doing okay. Talk to you soon.